All right, everyone. So welcome to Chapter 5 here on intraday chart patterns. So we're going to continue with the foundation that we've already laid, thus far, both through the starter class and chapters 1 through 4 of the pro classes. Everything that we talked about, especially with support and resistance levels and ascending trend lines, ascending and descending support and resistance trend lines, we will apply those to intraday charts as well. So let's do kind of a quick inventory of what do we already know. Well, we've learned about managing risk using a 2-to-1 profit-loss ratio with 50% minimum accuracy target. Realistically, as you know, my profit-loss ratio is about 1-to-1. I make 100, I lose 100. My accuracy is closer to 70%, and that's a fine way to trade. You just have to acknowledge that you have a 1-to-1 profit-to-loss ratio, you'll need higher accuracy to make up the difference there. And you'll have to be very careful about keeping losses very tight and not having one trade all of a sudden give up, 10 winners. We've also learned about finding the right type of stocks to trade. Going back to that really important metric of relative volume. Stocks with high relative volume are almost always easier to trade than stocks with low relative volume. And in our last class, we reviewed what good daily charts look like and how to find pockets or windows with virtually no support and resistance that can therefore allow large moves in stock price, potentially. Today, we're going to begin to dig into the intraday chart patterns that are going to become part of the trading strategies we'll be discussing in our next chapters. So today, you're going to learn, based on the intraday pattern, the correct entry point from a technical perspective. And you're going to begin to just recognize these patterns as they are beginning to form. So when you're watching a chart pattern or you're watching a stock and you're seeing, the first indicators that the pattern is forming, you're seeing the first leg up and then the slight pullback, and you're thinking, okay, right now it's a bull flag. We wait a few more minutes and it starts to become an ABCD pattern. So as those patterns are playing out in real time, initially it can be a little bit difficult because when I'm showing you examples of patterns, I'm showing you the example of the whole pattern, how it unfolded. So to only see half of it, the first half, and be able to then sort of draw the conclusion that this has a high likelihood of therefore doing this, it does take some time to recognize those patterns and recognize the implication as we're seeing it starting to form of what's likely to happen next. Remember, though, patterns by themselves are not strategies. They're just patterns, but a pattern is an important component to the strategies that we'll be discussing in quite a bit more detail as we get further into the classes. Now, the basis of my strategy is definitely, obviously, in technical analysis, so patterns will no doubt be a critical component. Why is it important? Well, I think I just said that. Chart patterns are, I wouldn't be able to trade without chart patterns. Now, it's true, as we talked about, that in the older days, people would trade just on the tape, and through watching the tape long enough, they would be able to form a sort of visual of what the pattern looked like. But realistically, at this point, I wouldn't trade without a chart, and I also wouldn't trade without the tape. I need both of them pretty equally. So when we're looking at charts, sometimes it's important to ask ourselves, if I was thinking about trading this the opposite direction, if I'm short and I'm thinking about going long, or if I'm long and someone else might be short, what would a short seller be looking at right now? Would they see something in this pattern that gives them confidence to hold, or to them as an indicator to cut the losses? What is the opposite perspective? Sometimes by sort of inverting the pattern or your bias on it, it can help you better see it because that confirmation bias can be such a problem. We can say, I think this is going to keep going and it looks strong and I'm just going to keep buying it and buying it. As an example on this stock right here, while this first 5-minute candle to make a new high, this red one, you could have said is a valid setup. It's also a very extended pattern. It's not really a proper bull flag. And it popped up and then pulled back. So at this point, if you're still holding, I would say that's a confirmation bias because realistically, this pattern has now broken on this candle by falling down here. And a short seller might have said, you know what, this is extended. I'm going to look for shorts with my stop maybe above this level. Okay, it squeezed through that. I'm going to put my stop up maybe around 57, up near the next $0.5 whole dollar. So being able to kind of flip the chart and see it in both directions will help you. Now, intraday charts, daily charts, remember from our class, whatever day you may have watched it, if it was yesterday or the day before, from our previous class, we know that when we have a super strong intraday chart, and a super strong catalyst that can override a poor daily chart. So, this is simply a fact. However, it doesn't mean that we don't want to, of course, do that confirmation double check to see how does the daily chart look. So as we go through chapter 5 here, the patterns that you're going to recognize on the intraday chart can be just as easily applied to those daily charts. So most importantly, though, focusing on the stock being in play. And sometimes when you're focusing on the stock that has the highest relative volume, let's see, where's our relative volume? So the highest relative volume, it's possible that you won't see the picture perfect bull flag, but you'll see other setups. And because the stock has such high relative volume, it just makes sense to continue to focus on it and be willing to trade whatever patterns appear. And again, just to reiterate, the patterns are only valid on the right stocks to trade. If you pull up a very light volume stock, one of the ones that have very low relative volume, and just maybe we could find a couple examples. So let's see, just trying to think of some stocks that, well, this is low volume. What's a stock? Can anyone think of a stock that has like zero volume today? Let's see, AKER, something like this. Something like this. This is not a stock chart that we would care about at all. So if you're looking at this and you're like, well, this does look like a flat top breakout over 270, you are probably the only person that sees that. It's a pattern that's an anomaly more than anything else. It's not something that's truly worth looking at. So we only focus on the right stocks to trade. And, if you try to apply some of these patterns and expect reasonable resolution to a stock, perhaps like Twitter, that's a large cap stock, you may see on some days at some times of the day that you get nice resolution, as you sort of have here, first candle to make a new high. But, the stock will have higher average volume than a lot of small cap stocks. But the fact that the relative volume is lower generally means it's going to be pretty choppy. So usually, even if the stock does have higher total volume because it's a large cap and it's a popular stock that people are focusing on, people are trading, it doesn't mean that that's going to be easier. So focus on the relative volume. The reason these patterns break out is because other traders see the same setup that you're seeing and are buying at or near the same price, and or short sellers are covering as it squeezes through those levels. So it's high relative volume that makes the pattern, even if total volume is low. Twitter might have 5 million shares of volume, and the stock that's on the top of the gap scanner, gapping up 70%, may have only 400,000 shares of volume. But because it is the leading relative volume leader and it's the obvious stock gapping up near the top of the scan, it is therefore the one to focus on. So we have to ask ourselves always, does this stock have high relative volume? Is volume coming in near or at the breakout spot? Volume confirms that we're right and that other people see the pattern too. And I will tell you that when the market is hot, trading is so much easier for me than when the market is cold. It feels like night and day, just how quickly stocks move, how strong the buying volume is when the market is hot. And when it's cold, it just feels like, a struggle. Stocks will pop up by 4 cents, then flush 15. And it's just chop, chop, chop. And, I'm at a place in my career and sort of in my profits where and let me just go on a brief tangent here, where I don't really like to mess around with that stuff. So as I sit right now, where, 5 weeks into the year, I'm already up over $700,000 on the year, or right around 700,000. So, to be honest, at this point, I could take the next 3 months off. Now, if I want to hit a goal of $4 or $5 million in the year, I do need to keep trading every single month. I can't just take a lot of time off. But the question that I kind of would pose is, do you think that, I should just kind of come in every single day and trade the best of whatever's moving? So if it's a cold market, the best of what's moving might really only be so-so. And those might be days where I really don't make a lot of money. And if I'm not careful and I take too much risk, I could incur some losses and I could even start a little bit of a red streak. Or should I come in, every day, but sit and be patient and wait for really good quality setups, wait for really strong stocks. And if that means that I come in every day and perhaps don't trade for 3 or 4 days, that's better than trading sort of subpar setups. I think there's different schools of thought on this. On the one hand, I have found a way pretty much every single day when I come in to find something worth trading. And I think that speaks more to my desire to trade than to the fact that there's actually something that strong every single day. You know, if I took the time to get up and sit down here, it feels like it's part of my job to be trading. But in fact, there are days, and really any day that I close red, I'll be asking that question of, you know, why did I even trade today? I knew that it was going to be choppy. You know, right now, for instance, we're kind of on the backside of momentum from that huge move last week. I expect the next few days may be a little choppy. And so this right now wouldn't be a good time for me to be stepping up and swinging big, looking for big trades. Now, I don't have to swing big every single day. I could just go for really small base hits. But, you know, and some beginner traders would say, well, look, I don't have the cushion you have. I'm not up 700,000 on the year. I have to trade every single day because I need to make $100 a day. But we, of course, know that in some markets, that daily goal is going to come a lot easier than others. And so if we're honest with ourselves that the current market is quite choppy and perhaps not justifying or suitable for large share size and, you know, big wins, then perhaps if I can't justify taking big size, which I would only take if a stock has really good potential, then perhaps I shouldn't even trade at all. You know, and then that's a question that I ask myself. So if we're sitting looking at the charts and looking at the scanners and we don't have anything that really has high relative volume that looks good, then, you know, the right decision may be to wait. And you just, I always, whenever the market starts to heat back up, I'm just always impressed by how much easier the trading feels from that cold stretch. And I'm always thinking, man, why were you fighting so hard during that cold stretch? You should have just eased off the throttle, because invariably fighting hard when it's cold, I dig myself a hole of unnecessary losses because I reduce my quality standard. And I wasn't honest with myself about the true quality of the market. So high relative volume does make the pattern. And unfortunately, there are some days where the highest relative volume stocks just do not fit within my strategy due to price, due to float, or just simply because their daily charts are terrible and maybe they pop up, you know, a lot pre-market and then just kind of fade by the time, you know, the bell rings. So the best time frame to trade on, when we're pulling up our charts, you know that I use my 1 minute, 5 minute, and daily. Now with the software I use, I can go down all the way to actually 1 second chart if I really wanted to. Now that's going to be very hard to visualize. I sometimes like the 10-second chart and keep it down here in sort of this small window because when you have a stock that's really volatile, sometimes the 1 minute candles are so big that it's hard to visualize even in those 1 minute pullbacks or 1 minute candles that there's a pullback. But sometimes there is a little pullback, like right here, and these occurred inside this move right there. So I do find the 10-second chart can be helpful for visualizing micro pullbacks, but I very rarely will be saying, oh, this looks like a 10-second bull flag or a 10-second ABCD pattern. While I see that, I'm not really doing a lot of drawing of patterns on this time frame because I don't really think many people use this time frame. This just helps me visualize when a candle is really strong, whether or not there are any dips that can provide that micro pullback entry, which we'll talk about when we get into the strategy classes. So when it comes to time frame, the minimum would be 1 minute, 5 minute, and daily. These are the 3 time frames that I really need. And realistically, if the 1 minute is surging and you haven't had a proper 1 minute pullback, you know, taking a 10-second pullback is risky. That's not a true pullback. You could be buying in the middle of the move higher or at the very top on a 10-second pullback. I did a 10-second pullback actually right here. This is essentially what I did on this trade right there. I got in for the break of 55 and, you know, it flushed down. And now the 1 minute at that time really wasn't formed yet. It was not, I didn't wait long enough. So sometimes the short time frames can actually kind of encourage you to overtrade, and pulling them off your chart can be good. And even stepping back and focusing on, you know, the time frame of the 5 minute, which is typically where we see the cleanest patterns and the best resolution. This is a good place to start. And some beginner traders will focus primarily on 5 minute and really only use the 1 minute for kind of that added confirmation. So, you know, for instance, I don't know. I mean, whatever. You see a bull flag forming here, and then you say, okay, well, then on the 1 minute, I'll just look for that little dip right below that level, and then that provides my, that's going to provide my entry. All right. So again, going back and forth between time frames, 5 minute is probably the most important on as a day trader, but I absolutely use the 1 minute and even down to the 10-second chart when I see a stock is moving quickly. So circumstances when I would not use the 1 minute chart. If the stock is extremely extended on the 5 minute, I may just be at a place where I'd say, listen, I can't do 1 minute pullbacks on it anymore. It's already done the first and second 1 minute pullback. At this point, it's just extended. So if we've already experienced, more than 2 pullbacks on the 1 minute chart and it's extended, I'm usually going to say I have to wait at this point for a 5 minute setup because it's just up too much. I'm less likely to use the 1 minute chart on higher price stocks because when we get higher price stocks, it's much more common to see false breakouts. And those false breakouts can result in 50, 75% losses like that. And so because the losses can get so big on higher price stocks, I try to focus on the time frames that give me the best confirmation, which would be the 5 minute. And then once the 5 minute looks good, focus on the 1 minute. And again, so in that instance of that trade that I took on Sava, the 5 minute wasn't there. And I was chasing the 5 minute thinking it was going to kind of keep going parabolic. But since I only had a small cushion on the stock, I really should have waited for a 5 minute setup and then been looking at the 1 minute to sort of give me the maybe confirmation once we already had 5 minute looking good. If the 1 minute chart is extremely extended off its 20 EMA, remember the moving averages on the 20 EMA on a 1 minute will be different than the 20 EMA on a 5 minute because 20 1 minute candles is a different average price than 20 5 minute candles. So we have the moving averages on each time frame. Now, if the stock is extremely extended off of the 20 on the 1 minute, I may also be more cautious, although I might take a trade. And I rarely would take a 1 minute entry if the price is below the 1 minute 20 EMA, just because that's a sign of weakness. Although I might do it in the case of a sort of dip trade off of a big flush or a reversal trade that I was buying off the lows. Circumstances where I'm much more likely to use the 1 minute chart would be when a stock meets all of our criteria for showing big potential. When it looks like it's starting to go parabolic, it's really starting to open up fast. We've got the low float, huge volume, great daily chart. It's hitting my scanner, it's ripping, and if I wait for the 5 minute setup, I'm going to miss the whole move. So for that reason, I've got to start jumping in on the 1 minute chart, generating a little profit on 1 minute micro pullbacks, and then scaling up if I start to build a cushion. The other scenario where I like to use 1 minute charts is when we have a 5 minute pattern that has just broken out to the upside, and then I buy the first 1 minute pullback after the fresh 5 minute breakout. Because a lot of traders will miss that initial 5 minute breakout, many of those traders will come in and buy up the first 1 minute pullback after the fresh 5 minute breakout. So you'll hear me talk about that quite a lot. And this is just a side-by-side example of a 1 minute chart on the right and then the 5 minute on the left. So you can see, for instance, here is a bull flag, right? So it breaks to the upside. And on the first, on the 5 minute fresh breakout right here, the first 1 minute pullback got bought up and then it rips higher. So on the 1 minute chart, you could have traded the first candle to make a new high, this is our bull flag. We could have traded that pattern, taken profit, and then added back on the 1 minute pullback, taken profit again. Now it's starting to pull back again. We'll let it pull back more. Now it's forming an ABCD pattern. 1 minute trade here, which is a 5 minute setup as well. First candle to make a new high. And then that surge up, then first 1 minute pullback. So by having the 5 minute and the 1 minute side by side, by using the 1 minute, I can sometimes take twice the number of trades if I was just using the 5 minute, which again can lead to over trading and sometimes getting in, getting out, getting back in, getting back out, which can churn commissions. But when the market's hot, it can allow me to, sort of rack up back-to-back winners. And at that speed, given the strength of the market, that makes sense. If the market is a little slower, then perhaps slowing down and not being quite as aggressive is smarter, because sometimes on a setup like this, maybe we see like a breakout, then a dip back below, then it breaks back out, and you'd look back on the 5 minute and think, geez, if I had just held, on the 5 minute chart, I wouldn't have gotten chopped out. I got stopped out of this and it ended up going anyways. So sometimes 1 minute charts and using level 2 will get you kind of prematurely knocked out of the trade and it ends up working anyways. But I guess I would remind you that typically the best setups work right away. And so therefore they would work right away on the 1 minute and just take off. So, and the ones that are a little choppier, usually, even if they become winners, are not going to be one of the biggest winners. So one of the reasons that I drew circles here around both the candle and the volume was to highlight the increase in volume that comes in as the first 5 minute candle makes a new high. So the first 5 minute candle made a new high right here, and we saw an increase in volume as those 1 minute candles were breaking, because those 1 minute candles were the moment the first 5 minute candle was making that new high. And so we see that volume spike here. Now we do see a high red volume here as it did a topping tail and a rejection, but then it recovered. Higher green volume here on the first 5 minute candle to make a new high, and higher green volume here again on the 5 minute candle to make a new high. And what we're seeing is this ascending volume, which is what we would call the volume profile. So if we weren't looking at the chart at all, we were just looking at the volume, we would see that, wow, volume on this stock is increasing. More people are getting interested in it. And we like to see that. When the stock continues to go higher, but volume is decreasing, it can be for a couple reasons. One, it can be because the stock has moved so much that buying the same number of shares costs double the amount of money in the case of a stock that went from like $4 to 8 to 10 to 12. So in those situations, we may see volume decline because the total number of shares, just because the price is higher, buying the same number of shares would take more buying power. However, usually a really strong stock would have enough fresh traders coming into it and more people trying to buy more size in general that we would see volume continuing to increase even as the price is going higher. And so then the other reason why volume is decreasing is because people are getting more hesitant about buying something that's up this high. And when we're beginning to see that divergence where price continues to go, but people are getting more hesitant, that can sometimes be a little bit of a caution flag of an incoming reversal and what could be a swift reversal coming back down. As a stock squeezes up on light volume, that'll be more common on a lower float stock where there just aren't a lot of people that have orders to sell. So, it's sort of thinly traded, and the people that are maybe getting squeezed out short or that are still chasing it long can just kind of bid it up higher and higher and higher. But if you don't have those same buyers stepping up on the bid side, when it does roll, it can come right back down really fast. So that divergence of moving up on lighter volume is definitely something to be cautious of. But this pattern is okay. First pullback was not perfect with this topping tail. It popped up and pulled back, but it was okay. Second pullback, not bad. Third pullback, a little choppy, but it did continue higher before finally rolling over here at the top. Here's another example, a different chart, different stock, but such a similar pattern. If you blinked when I flipped that, you might be like, oh, I'm looking at the same chart. Okay. Yeah, we've got high volume on the first 5 minute candle to make a new high, kind of coming in right there. High volume on the second time it did that, the second 5 minute pullback. So very similar volume profile, volume generally increasing. Obviously these are different patterns, there's differences, but very similar. So these are the type of things that I would encourage you to be printing out and sort of having around your desk space, your workspace. So when you start seeing something like this happening in real time, you're going to be able to start to remind yourself, okay, the last time I saw this, this is what happened. Well, now this had a high red volume candle at the top. That is a red flag. So this one wasn't picture perfect either, but it worked. And again, showing you how the 1 minute can sometimes give you that early entry. So this was the first 5 minute candle to make a new high. This was a 1 minute micro pullback. Then it does a really nice clean rip, and that cleaner move actually was following the 1 minute pullback after the fresh 5 minute breakout. That just happened to be cleaner right there. It pulls back again into this little wedge, showing it looks like some support around $1.60, and then it breaks out of that and squeezes higher. One of the strategies that I trade that we'll talk about in strategy classes is simply buying the high a day break. So as it breaks a new high, getting in and then just taking a quick profit. The challenge with that is that can work well in a hot market, just buying high and then selling 10, 15 cents higher, depending on the price of the stock, maybe 20 or 30 cents higher. But in a cold market, you'll buy the top, it'll go up 3 cents and then flushes 15. And so you keep getting stopped out. But that's not uncommon, in fact, that a strategy that works well in a hot market won't work as well in a cold market. And so you will notice that probably across the board, but certainly with an entry at the high. certainly that's going to be riskier. In a cold market, having a dialed in entry near the lows of the first candle to make a new high is going to be safer. And here's yet another example. So this stock squeezed on the 5-minute chart from $2 to $6. Now, if you were a 5-minute trader, you would have just been sitting here twiddling your thumbs, faster and faster. Gosh darn it, this thing keeps going higher. I'm missing the whole move. 1-minute traders, of course, probably would have bought this first 1-minute pullback right here for the break through $3. Another 1-minute pullback right here for the extension up to $6. Because it was moving so quickly, buying around those levels probably made sense at the time. It then does pull back. It dips down to that 20 moving average, which is on the 1-minute chart, bounces off that level. On the 5-minute, it ends up being kind of a nice tap off the 9 EMA, not perfect, but pretty nice. First 1-minute candle, as it breaks out, it does the 5-minute breakout, and then the first pullback after the 5-minute breakout gives us that nice ramp up to 657. Pullback here, kind of squeezes up here, but a little extended on the 1-minute. Not a very clear setup, and you can see it was the first 1-minute candle to make a new high, first 5-minute candle to make a new high, but on the 1-minute chart, it just kind of squeezed higher. It wasn't really a 1-minute setup. So there are times where by the time the first 5-minute candle is making a new high, the 1-minute is already up, 40 cents off the low. And you're thinking, well, yes, it's a 5-minute setup, but the 1-minute is too extended. I can't trade this. And so if that's the case, then that gives us even more reason to wait for the first 1-minute pullback. Now, if you really stick with the 5-minute chart and you take that entry, your stop is at the low. So you ended up, in this case, you would have been holding through another consolidation, putting yourself at unnecessary exposure risk for a loss. And so therefore, the 1-minute chart would have given you actually the red flag to probably not take this on a 5-minute. And then maybe come back here, and as it curls through the high, now that is a flat top breakout pattern. That's looking a little bit better for that squeeze higher, right? So there we've got that move up to 8, pullback, the pop up higher, pullback, up higher, pullback, and then up to 10. Stock literally goes from $2 to $10. And you could see how it wouldn't have been impossible to buy the tops on it in some of these places and get stopped out for a loss. Sometimes these stocks can be choppy, and while they do make a big move, and if you step back to the 5-minute or a 15-minute or a daily, it's like, wow, this thing just went straight up. There was no way you could have lost on it. But in fact, it is certainly possible. I am proof of that. So here's another example of 1-minute versus 5-minute. This stock goes from $2 to $6.79. Basically straight up. It doesn't even do a 5-minute pullback. And then by the time it's starting to do a 5-minute pullback, well, it's already gone up 300%. So now you've had a stock that's gone parabolic. While sometimes they can sustain a pullback and continue and end up making that really crazy move, it's also very common that they make these crazy moves and then they just kind of fade. And so in this case, the circles here are possible entries just at $half and whole dollars, which could have been around micro pullbacks on a 10-second chart or using the level 2. The first 1-minute pullback was actually right here, around 450. And that resolved very nicely from 450 to 550. Up here, a little higher, sort of micro pullback, a little dip, and then the next rally up. High a day entries right here would have been fine. This was a hot stock moving quickly. It continues higher all the way up to 680, but then eventually flushes, pretty hard off that level, back to the 20 moving average, and then breaks below it and is now starting to look a little bit more bearish. So the most popular patterns that we're going to be talking about, these are the ones that we have right now that are part of this class. I've, over the years, had some patterns that I added in and then some that I sort of pull back out. I think, I don't know, that's getting a little too complicated. So this is what we have right now. And let me just actually double check. Let's see, what slide am I on? So I'm on slide 300. Let's see, going down. Now, I actually have one pattern that I added in here at the last minute. So I'm gonna, let me back this out here real quick. I'm gonna go right here, back up to here. So I added at 8 head and shoulders pattern, and then 9 is caution on the bear flag, or bull traps and bear traps. Okay, so I've added one more for this class, which is head and shoulders pattern. All right, so these are the patterns that we're going to break down here as we get into the meat of chapter 5. And each one of these patterns is going to be its own part. So these will each be in shorter videos, which will make it easier for those of you watching this in the learning management software to go back, months or weeks or whatever it is down the road and just go back and get a quick refresher on one particular pattern. And it also makes it easy for me if I do think of another one that we're starting to see is more common to go ahead and add 10, 11, 12, because I could just slip in part 11, 12, 13, 14, etc. So this is subject to change if down the road I added more patterns, but let's go ahead and jump in with chapter 5, pattern 1, bull flags and bear flags. All right, so the first pattern we're going to talk about, chapter 5, pattern 1, bull flags and bear flags. These are probably the most common patterns that we see as traders. They really are, and so it makes sense to cover them first and foremost. We did cover them in some level of detail in the starter class, which was new for this year. Previously, I hadn't really gotten into that much of the intraday patterns, but I wanted to give those of you that went through the starter class sort of an early taste at some of the funner stuff, which is the patterns and seeing how they resolve and everything else. So let's break down the bull flag. Now the bear flag is inverse, so we're going to focus on the bull flag, and then I'll show you some examples of the inverse, which is the bear flag. So the bull flag breakout pattern is a very well-respected, very popular pattern, which consists of a flagpole, which is the first candle to move up. So one candle basically goes straight up and creates the flagpole. And then you usually have 2 or 3 candles that go sideways, which create what you would, I guess, visualize as the actual flag, all right? And then the first candle to make a new high is as the stock breaks out of that pattern to the upside. So our entry point can be, for a proper entry, the first candle to make a new high. We could consider doing dip trades as it's still selling off if we believe that it's dipping down to a critical level of support, which could be perhaps a $0.50 or a whole dollar, or if maybe the volume weight average price, but usually it's going to be above that. And then the second entry is just to buy for a breakthrough high of day, which is high risk, but usually comes with a confirmation that it is going to squeeze higher. So the volume profile is also important. And what we typically like to see is high volume during the initial move up, light volume during the consolidation, and then volume coming back in as we squeeze through the highs. That's what's most common. That's what we typically look for. All right, now, let's see. So right, typically high volume in the initial squeeze up, light volume on the pullback, and then as the first candle makes a new high, volume coming back in, and that high volume carrying us through high of day. There are times where we will have stocks that sort of buck that trend, which is they have light volume, but they do continue higher, and we have that divergence. Again, those can sometimes be opportunities for trades, but the risk is usually higher because the fact that the volume is not keeping up with the movement of the price is an indicator either that people are just afraid of trading it or, something's not quite right when that's happening. And we sort of see that a little bit to be the case on this pattern here on Sava, as this is a premature breakout. So this did not give us the proper, 3 red candles. It only gave us 1 red candle. The volume profile was great right here. We had nice high volume ramp up, light volume pullback, and then all of a sudden it just starts going. So when we have a pattern like this, I wouldn't really say that this was a bull flag. It's certainly not a proper bull flag. It's not even really an improper bull flag because this high red candle, the next one just went higher. It didn't actually have a pullback. And you can see, although the volume is picking up a little bit, to be honest, I think more than anything, that's going to be short sellers getting squeezed out a little bit as it just kind of pushes a little higher. But when you have that topping tail candle, what do we know the topping tail candles communicate? They communicate that indecision. They communicate that it squeezed up, but it couldn't hold those levels. And so even though that topping tail is only on the 10-second chart, the 1-minute chart is showing a doji. So right now, this is an example of a stock that while it's moving higher, might trigger you to press that button to buy as sort of a FOMO entry. But when we go back and look at the 5-minute chart, the 5-minute is not giving us confirmation, which means any entry on the 1-minute, therefore, is much higher risk because we're still trading an extended 5-minute pattern. The better patterns will also be the bigger winners. They're more predictable. Most people understand them. The entry is very clear, it's obvious, and we will see almost instant resolution and increasing volume at those apex points. So the proper bull flag, and it can be sometimes just two red candles to pull back, but we do need at least one pullback candle. So usually 2 to 3 or maybe 4 green candles going up, followed by 2 or more red candles coming back down. So a few candles going up and a few candles coming back down. Now, on the pullback, a perfect 5-minute bull flag will pull back right to the 9 moving average. It comes right down to the 9 moving average, then bounces off of that level. I'm going to move my video to the top corner. So 9 moving average is our support level. The entry point is the first candle to make a new high after what are usually 2 red candles. 1 red candle can work, but only if the previous candle was higher. So in this case, the highest candle was red. It wasn't green. If the highest candle was green, and then this candle was red and it was a little smaller and it was an inside candle, that would be a little bit of a premature breakout, but at least would be a little bit of a pullback. The highest candle was the red candle. It dipped for a second and then it surged higher. And when you start getting these types of moves, this is where, you start getting a topping tail like that just all of a sudden squeeze and then just has a hard, fast drop. And those are not fun to be holding during. So the entry point is the first candle to make a new high, usually after 2 red candles, a tap of the 90 EMA on the 5-minute chart with a stop at the low of the last 5-minute candle. And a bull flag should not retrace more than 50% of the initial move. So if the stock goes from $2 to $4, a pullback to 3 is okay. A pullback to 250 is not okay. A pullback just to 375 is fine. It's a very tight flag right underneath the highs, and the only risk there is that it's possible, because it's up that much, that it hasn't pulled back to the 9. It's a consolidation right at the very tippy top, and those unfortunately can sometimes result in false breakouts where it breaks out, but only by a teeny bit and then quickly reverses. So the question of how do you know a pattern is doing a bull flag pullback and is not just selling off? Initially, we don't know. Initially, all we know is that the stock is pulling back and is selling off, which is why usually we don't want to be holding as it's pulling back off those highs. So again, in the case of this stock, right here, when it started pulling back, we didn't know that this wasn't the beginning of a sell-off back down to the volume weighted average price. We didn't know. We didn't know that it was going to come back up here. If you had known, you could have just bought here at the very tippy top, hold through the entire pullback, and gotten out up here. But at the moment, what we saw was, red candle, a false breakout. This candle is a big red candle, higher volume, and it's pulling back. This, for me, is not a very clean bull flag, as you can see, because the volume profile. It did this premature pullback right here and then kind of went higher. That sort of breaks the whole pattern. This chart, in fact, today has not really given a single nice bull flag. Perhaps this area here is the closest thing to it, but this one also wasn't perfect because of how much it pulled back. And that's sometimes the case. Now, this stock, just because it didn't do a bull flag doesn't mean we wouldn't trade it. I'm willing to look for alternative setups, and those will be one of the other setups we talk about as we get in more to the intraday chart patterns. But when it comes to the bull flags, what we like to see typically is a pullback not more than 50%, a nice retracement around the 9 moving average, and we wait for that first sign of strength, which is, again, the tide kind of rolls out and then comes back in. And it rolls out, or each wave rolls out and comes back in. And the question is right now on this stock, is the tide coming in and we're seeing momentum increasing, or is the tide going out? I would argue on this stock right now, the tide is coming in and we're still seeing an increase in volume and an increase in momentum. And so trading 1-minute pullbacks when the tide is still coming in is fine, even though it is a little extended. But when the tide starts rolling out, that's when we have to be really careful to wait for that first candle to make a new high, to wait for that confirmation that the trend is shifting from selling off right here to now curling back up. All right. And the bear flag is the exact inverse. And so if we look at GME today, GME did a pretty good bear flag right here. It sold off hard at the open, right down here, straight down. It bounces up for like 3 candles. Now these were light volume candles, high volume sell off, light volume bounce, and then the first candle to make a new high or new low sort of, it did a little false, it dropped and then it popped up and then it kind of rolled over. So the resolution wasn't perfect, but that's the idea. And if we look back on this, you can see how in the last like 12 hours, it kind of keeps selling off and then consolidating for a second, like here, and then going lower. And these are essentially, each one of these are bear flags and then the drop lower. Some of them are quicker on the resolution, and some of them, like this one from early pre-market, took a little longer. And that's true on the long side too, that sometimes we will see a sideways consolidation that isn't 2 or 3 candles, but becomes 6 or 7 or 8 candles. The only problem is when that happens, unfortunately, we don't really look at it as a bull flag anymore. It's just sort of continued momentum. So now let's look at some examples of bull flags. Okay, sorry, just resuming here. So I got my tea, ready to drink. Okay, so this is a bull flag example here where we've got this nice ramp up. So, all of a sudden the stock starts squeezing up, volume increases as the stock is hitting high-a-day momentum scanners. It's drawing people's attention as Robinhood and other trading platforms are blinking. Stocks hitting new highs, stocks hitting new highs. People start pulling it up, looking at it, and jumping in. And we know, again, how much the market is sort of in this mob mentality. I usually like to be trading with the mob. I mean, I don't know what else to say. I want to be trading what other people are trading. I certainly don't want to be trading against them. I trade in the direction of the general trend, the general bias. And when everyone's sort of, crowding on these couple of stocks, those are the ones that I usually want to be focusing on because they're going to have the most volume, they'll be the most predictable. And so here we see that squeeze up from 3 to 350, 360, 370, 380, tapping what level? The whole dollar. Psychological resistance there at 4. It then pulls back. 1 red candle, 2 red candles. First candle is green, but it doesn't make a new high. It's just a green candle. It's actually an inside candle. So just a small green candle there. And then the next candle is the entry. First candle to make a new high was on this candle right here as it broke the high of this green candle. Let's look at the volume profile. Volume ramping up, increasing, decreasing during the pullback. A light volume pullback tells us that people aren't panicking. They're not panic selling. Short sellers are not aggressively hitting the bid on the stock. That we're getting this sort of natural pullback, some to be expected profit taking, perhaps some people who shorted with a stop against the high, covering as it comes down, but then finding support here around our 9 moving average as we get ready for the next leg higher. So this is the moment where, as it started to base out right here, and even show on the 1 minute probably a couple of green candles of consolidation, that's where we would have been starting to think, okay, is this the formation of a bull flag? And if it is, where's the proper entry point? It's the first candle to make a new high. Where's our max loss? It's the low of the pattern to be official, but sometimes I will use what I would call an arbitrary stop, which would be setting a stop maybe just 15 cents away, because as we know, the strongest stocks and strongest patterns resolve instantly. The best trades work instantly. And if it is not working instantly, then I'd rather just get out and wait for the, come back for another opportunity. So take a 15-cent loss and then maybe get back in. But this ends up resolving and squeezing through the high. Our target is always high of day. But when we talk about the ABCD pattern, you'll notice that the formation of an ABCD pattern begins with a bull flag that doesn't go all the way back to the highs. That pops up, but not all the way back to the highs. So we can look at this live example here of Sava. As this is forming right now, I'm starting to ask a question, is this a bull flag? So we have a obviously big move up, and then the high was 74.50. And this candle here, how much time is left on it? We currently have 30 seconds left on this 5-minute candle. So when this 5-minute candle closes, then the first 5-minute candle to make a new high would be over 71. So I could have an order and type it so it's ready to go at 71.50 perhaps. We still have a few seconds left on this candle. It's not quite ready. It's a little premature here. 8 seconds left. And just like that, it breaks prematurely. So now the high of that candle is 72, which means the correct entry on this would be actually $72 a share. Now that's a little higher than we like for an entry. So at this point now I would kind of say, well, The 1 minute and the 5 minute are not really giving me the multi-pattern alignment that I need. The 1 minute's just kind of going, and now I'd be chasing it, right? If I got in there at 72, I'm chasing it. We've already got 3 big green candles in a row. Our high is 74.50, so I could do a trade over high a day, which we know is a place where short sellers would likely get stopped out, but that's kind of the only setup that's left in this. So just to show you kind of my order process here, let's go to Sava. So 74.50, 250 shares. So the high of this current candle is 73.76. And you could say that this is a bull flag. Technically, it's only one candle of pullback, but it is resolving. Although, because it's a little premature, we do have the risk of it being a double top against the high, which is 74.50, right? So you see there, we've got a doji with a high of 73.76. You know, it's not, it may take a little bit more time. This may need to pull back here before it's really ready to go, but I'll leave the order at 74.50. Essentially, what we're looking for now is the first 1 minute pullback after the fresh 5 minute breakout. If this breaks through 74, that's where I'd be thinking we might get a quick squeeze up to 75 or 76. So trading with smaller size. In the morning, I would trade a little more aggressively, but at this time of day and on a higher price stock, I have to be a little careful. So watching, tides coming in just a little bit. So we've got our 5 minute, but you know, the 5 minute's a little premature. It's not the perfect pattern, but then we look for the first 1 minute. And essentially what we're seeing right here on the 1 minute chart is a bull flag. This is a small little bull flag. The high is 73.76. So we're getting a 1 minute pattern here inside the 5 minute pattern. So now we're starting to get a little bit of multi-time frame alignment. Now this may end up, you know, we still have 2.5 minutes left on this candle. So it's starting to curl back up there. I don't usually have my neck this like twisted when I'm looking at my level 2. So first candle to make a new high is in about 7 seconds. So here we go, taking a starter there, looking for the break through the high of 73. So watch this through 73. Right here, this is a 1 minute micro pullback. So I'm looking for the break through $73, which is the high, 73.76. And then we want to see the curl through 74. So my cost basis is 72.55. About a $1 stop, which is the low, 71.10. So stop's about $1 a share away with 1,000 shares, about $1,500 of risk, maybe $2,000 at most. I want to wait for that first 1 minute candle to make a new high, which right now it looks like would be about 72.80 on this current bull flag. So let's watch 72.80. And there, just like that, it flashes down. You can see the tide starting to roll back out just a little bit. The high of this candle is 72.80. Is it not able to hold this level? I usually don't like to panic sell. I like to give it a chance to see if it'll pop right back up. But in that case, I got to cut it loose because it's dropping and breaking that low. So in this case, you have what started initially as a 5 minute setup, the first 5 minute candle to make a new high, but the 1 minute didn't give us that alignment. So the 1 minute wasn't quite ready. Taking the first 1 minute pullback on this one, well, you know, the first 1 minute pullback on this didn't quite work. It was just perhaps a little too extended. Not enough people felt confident in it. I would still say that if this breaks over 74.50, that's the line that I would be bullish on. But let's also acknowledge the current time right now is that we have only 13 seconds left on this 5 minute candle, which opened at 71.84 and is looking right now like it's going to close red. So if it closes red, although it's a light volume candle, and there it is, it closed red. So now what we're getting here is the beginning of what's called an ABCD pattern, which begins with a bull flag that fails. Now an ABCD pattern, which we'll talk about a little bit later in chapter 5, will be if this in a few minutes, maybe 15 minutes or so, ends up holding this low here of 66.23. It's got to hold the low, and then we'll look for the break through 74.50, which is very close at this point to, I guess, a flat top breakout. All right, so let's get back into the slides while we let that pattern consolidate, and we'll see whether or not it does end up giving us another trade. All right, so this is NVFY. Now we have AKER. So AKER, you can see this squeeze up. High volume was on a red candle. Light volume pullback, which is good to see. We're definitely happy with that. First candle to make a new high is right here, about 275. It breaks that level and squeezes up to 320. Nice resolution on that pattern. That pattern is a little cleaner compared to something like Sava. Sava is certainly fairly extended already, having made a big move. So sometimes, they need these periods of sort of sideways consolidation. But initially, when something first starts to open up, that's when we can find sort of those first opportunities to buy that first pullback or the second pullback. First and second pullbacks are our favorite. So here is CCXI. On the 5-minute chart, first candle to make a new high, not really picture perfect, right? You can see how it kind of pulled back and then it did pop. It was the first candle to make a new high, but now the 1 minute provides so much more context. Now the 1 minute looks a lot cleaner. So you can see here the first 1 minute candle as it broke through this sort of resistance around 387, 390. Then we would have been anticipating the breakthrough 390 and $4, and we got the squeeze up to 423. And then what's this pattern right here? This is now a 1 minute bull flag. This is the first 1 minute pullback after the fresh 5-minute breakout, which is exactly what I was just trading on Sava. But in this case, it resolved the right way, up to 433. Here's another bull flag. That nice squeeze up on high volume, pullback, first candle to make a new high, 424. Stop is 418, the low of the pullback. That's a very tight stop, only 6 cents a share. And then resolution as it squeezes through the high. So the setup here, first candle to make a new high, is pretty clear. Yes, there was higher volume on this red candle, but not outrageously so, not too bad. Light volume pullback is great. Tap pretty close to the 9 moving average and then resolves off that level. This is also the right price. It was the right float. It kind of had everything else going for us. Now, the bear flag is the inverse. So I showed you an example on GME, but a couple other examples. Sell-off, brief pop, lower. Sell-off, brief pop, lower. 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 So you flip that, and that's when we're trading the first pullback, the micro pullback, as it's going higher and higher and higher. One of the things, and there's another one, there's a pullback, a pop-up, a pullback sideways, and then a little bit lower. And here's another one, a strong sell-off, consolidation right above the lows. So I would never want to be long holding that type of pattern. That's a bullish pattern. It is not strong. And here's a little bit of a different bear flag where we have first a sell-off, a pop, and then a fade. Curls back up, drops, a little pop, and then fade. Little pop here, and then just sort of fading lower. So that becomes a little bit of a longer bull flag as it just sort of drifts lower, which, is sometimes the case. Sometimes it's not really, really dramatic, but obviously the best setups are. As part of intraday, this section, chapter 5, I'm doing kind of a quick, this is what the pattern looks like. It's sort of a cookie cutter. Here it is. And now when we get into chapters 7, 8, and 9, a lot of the examples that I show you of ABCD patterns, first pullbacks, etc., will be you then seeing a lot of examples of that pattern. So I'm not going to do every example I've ever seen of a bull flag or a bear flag in this section. Those are going to come more as we're going through strategy. This is more of, this is what the shape looks like. Remember it. Print out the chart, put it on around your monitors, etc. And then when we get into chapters 7, 8, and 9, remember it because you'll be seeing it again and again. All right, so let's continue on here with pattern 2. All right, so now pattern 2, flat top breakouts and flat bottom breakdowns. These can be particularly powerful patterns because when we have this period of coiling and kind of tight consolidation right underneath a level, when it breaks, the price can snap. And then we get that quick rip. And we saw it on a couple little trades, I suppose, on Sava. I think that we probably would see it if it breaks over 74.50. It's pulling back a little bit right now. And I'll show you a bunch of examples of it here. But what we look for is that quick break through that level and then that snap. So a flat top breakout pattern and a flat bottom breakdown is the inverse. Flat top breakout pattern typically has the following characteristics. Usually 3+ green candles in a row, moving up, followed by 2 or 3 candles of sideways consolidation. Usually we want at least 2 candles of sideways consolidation. So it's kind of like a bull flag, except that it's all right under the high of day. It's not actually pulling back, it's just going sideways. But the period of going sideways allows some people to take profit and some short sellers to maybe go short, and then some long traders to see, okay, it's still holding up. I think I want to go long, and then, you know, it moves out through that level. We'd like to see continued consolidation, you know, and ultimately kind of resting on the 9 moving average for a nice moving average support. The entry point is the first candle to break the high of day. Now, a flat top breakout can sometimes be underneath high of day. In the case of, I think we were looking at General Electric earlier. So, you know, this is obviously not like a stock I would trade, but that at 15 there, 11.15, that was a flat top breakout, and it's okay that it wasn't at high of day. It was obvious. And now up here at, it looks like 18 or 20, 18, you've got another type of flat top breakout. It surges through that level. And so as it surged through that level right here, you know, with some volume, it's a little funny that it broke down before breaking up, but that 11.18 level is still valid because that was clear resistance. So if it can break through it, then we're looking for the next leg higher, right? Now, again, General Electric is not a stock we would typically be trading. Part of the reason it's got such a tight range is probably as a result of the high frequency trading algorithms, but it happens to make a nice flat top pattern. So this is a very long, stretched out flat top pattern, and sometimes they can form over the course of hours. This had very clear resistance in the 70s. It tapped 72, which was the very high, but it also kept tapping 71, 71, 71, 71, 71. And then finally, it surged through that level. Once it broke, it broke. So remember that some traders would say on, you know, let's just say Fitbit, whatever. Oh, Fitbit got bought out, didn't they? Anyways, so we'll just ZVZZT. So ZVZZT, NASDAQ test stock, let's say 10.02 is the top of the, you know, the flat top. So I could just be sitting here with my hand on the buy button or my hand on the Shift 1 hotkey, waiting to press it to jump in. But remember, I can also use a buy stop. So I could say stop at 10.05, and it's a buy stop. So now, and I have this as a live order down here. Now I can walk away, I can go for a walk, I can go do whatever I want. If this breaks 10.05, my buy stop will trigger, and I'll be long at, well, it's a market order. So I could be long at 10.05 or as high as, well, as really any price because it's a market order. If I used a stop limit right here, I would stipulate the most I was willing to pay, which maybe, let's just say, in this case is 10.10. So that order there is with a limit. I'm going to cancel them. But because some people do that, both for swing trading purposes and for kind of, you know, longer hold day trades, when a stock breaks a critical level, we can all of a sudden see that surge of volume come in, not just from day traders who are like, okay, I'm going to step up to the plate, but also from those orders, those buy stop orders that go through, or someone who's short and has a buy stop to cover the short position. So what we often see is that when the stock finally breaks that penny, it rips fast. So because of that, I often will want, as part of the strategy of how to trade that pattern, to be getting in a little early to anticipate it. We'll talk about that when we get into strategy development, but this is the pattern. So this is a very long flat top breakout pattern. This one's also a very long flat top breakout pattern. Long consolidation under 55. It's got ascending support there, so it's kind of like a little wedge. And this is a pattern that I do love it. We don't see it all that often, but when you see it, it's a no-brainer. To me, at least. It's just so obvious. It's plain as day. Patterns that are plain as day that anyone can see will often have better resolution because there's more people seeing it, therefore more people buying it, more people setting their orders around it, etc., etc. What we don't want to see is a U shape or a double top. That's bearish. So what does that mean? When you have a stock that squeezes up quickly, and let me just get my, I'll do a little note drawing here. So I'm going to draw for you the double top. All right, so let's see, stock squeezes up like this, then pulls back, pulls back, pulls back. So this right here at this top level, that's a double top. So the stock did its proper bull flag, and the proper entry was right here. The proper entry was the first candle to make a new high, right? So that's the place to be long. So if you're buying right here, that's not really a flat top. That's a bull flag that resolved correctly and is now at the high of day. While we could consider a trade there as a high of day breakout, that's not a flat top breakout pattern. A flat top breakout pattern is one that I would consider typically to be lower risk, whereas a double top pattern like this has a high risk of being a false breakout at this level and then fading. Now, if it fades off that level, it pulls back and then comes back up again. Now we're starting to look at possibly a flat top breakout. Once it's tapped once, twice, and now coming up for the third attempt. Again, if a stock is really strong, I should get like a football player, like a basketball coach. I should get a whiteboard like this. I'm gonna see if I can find one. So anyways, once it starts to form more of a flat top, that's okay, that's fine. And in this case, this is a sort of longer extended one. But if we see that U shape, well, that tells us that this is not really a flat top, it's more of a bull flag. And the correct entry point, we've probably already missed it. This here, again, you can see this is a flat top breakout pattern. So back to the full screen. It's got a very clear resistance at the whole dollar. That's very common, resistance at the whole dollar. So flat top breakout, consolidation underneath the whole dollar. I don't know why, I must have changed this chart. So let me just go and correct that. So let's see. What chart was this? So for the whole dollar below $5, not below 8. So yes, at 5.95 provides an easy entry at 5.95 to anticipate the break through that level. All right, so I've updated that on my side. Here's another one. This is a little bit more like the pattern I just showed you, where in this case, the bull flag, it wasn't really clear. So this is a time where we don't feel bad that we missed, the dip entry or the pullback bull flag entry, because this just wasn't really, it just all of a sudden kind of squeezed back to the high. So it squeezed back to the high, but then it fades off that level. It comes back up for a second try. Now, this does still have kind of a lot of, negative space in here, which is that U shape, but it's a third attempt. It's also at the whole dollar. So in this case, you're right, 4.95, thank you. But in this case, an entry at 5.95 would have been fine. And a comment on the chart on Sava. In fact, yes, Sava was a bit of a double top here, and this would have been a pretty high risk trade, to be honest, an entry up here at the top, because the previous high was a topping tail and rejected that level. But the market was hot enough today that this did continue higher despite that. So, sometimes they will keep going. But again, that's not a flat top pattern at that point. Okay, so here's another one. It curls up once, pulls back, comes up a second time, pulls back. Now, again, in this case, I don't think that we would have been buyers down here, because that's not, what pattern is this to be long here? Possibly a break of the volume weighted average price and the break of the whole dollar of 4. And considering this is a stock that had a range of 250 to 7, maybe we would have been willing to stretch a little bit and take some of those kind of higher risk trades. But this is not the cleanest or clearest pattern. But once it shows the tap once, the tap a second time, drop back down, and then the curl back up, it makes sense to go for that trade through 5. It starts to become obvious. So that becomes a bit of a flat top breakout pattern. It's not that really, really tight wedge, but it's a clear, at this point, double top, and this is the third attempt. Now, the flat bottom breakdown is the exact inverse. This is preferred by a lot of large cap traders. You won't see me trade it that often just because of availability of shares to borrow to the short side, etc. COHN here, very clear flat bottom at 17. So we would have been probably looking to short this, around 17 for the breakdown and the sell-off lower. Makes sense. Here's another sort of flat bottom right here at on WUBA, which was sort of consolidation down here above 55. So consolidation right above the whole dollar, and then it drops back down. Next one here. Okay, so this is a little different, where this is mostly a bullish chart, but it broke the VWAP, came back above it. Broke again, double bottom, triple bottom, came back above it. Came back again, came back to it, and then here finally it gave up. And so you can see, look at the resolution on that. Now, I think that one of the reasons this had good resolution was because it was a very obvious pattern. It was a very obvious level of support there at 366. So a lot of people that were holding probably would have said, okay, stop is, 367. I'll put my stop just before it breaks. And other people said, oh, I'll put my stop at 359. I'll wait for it to break. And other people might have said 350. So you have all those stop orders out there. And then when it finally cracks that level, all of a sudden it drops. It drops hard. It pops up. And now what's that pattern? A bear flag. Sells off again hard. Pops up again, sells off more. Sort of double bottoms here into the close and then kind of flatlining here. So it's very common that a stock that we're actively watching will exhibit multiple patterns at various points during the day, both on the 1 minute and the 5 minute. We might see flat top breakouts, bull flags, ABCD patterns, bear flags. We could see all of them in one stock through the course of the day when you're including the 1 minute and the 5 minute time frame. So it's not necessarily your job to trade every single pattern that shows up on a stock each day, even if that is the right stock to trade. It's important for your goal to be to get in the market, to get your 10 cents a share with as little risk as possible, ultimately. So focusing usually earlier in the day when we have higher relative volume. If you're trading to the long side, trading when we're sort of on the front side of that momentum, and then not overstaying your welcome. You can certainly trade all the way to the close, and you can even trade after hours. But while that may be beneficial in the simulator for the benefit of gaining experience, with real money, you start getting into a situation of overtrading, which can easily happen when you're staring at a 1 minute chart, generating commissions, burning commissions, and every trade you take, there's a cost. If you're paying $5 or $2 or whatever your commission is, every time you take a trade, there's the cost of the trade, plus there's the fact that you have your risk of your entry versus your stop. And then every now and then, you'll see a trade like whatever, all of a sudden it flushes down $5 a share. And just like that, in one trade, you gave back, 8 trades of profit. Inevitably those things will happen from time to time. So the more you're in the market, the more you expose yourself to those things happening. But again, the more you're in the market, if you have good accuracy and you can be disciplined about the time of day you trade the most aggressively, part of the calculation of profitability does come down to how many times a day you trade. If I traded only 3 times a day, I would make a lot less than I'm making right now trading, 20 times a day or whatever it happens to be. But yeah, so anyways, all right, let's continue on here. This is another one. Flat bottom here, a little harder to see, but double bottom there, and then extending that here. It sold off and bounced off that level, then flushed through it. So not the most obvious, but it's there. You can see it. Here we have a double top, and this is an example of double top at the whole dollar of 6. So it comes up to 6, it rejects it, it flushes down. So that becomes a little bit of what we would call a bull trap. People probably bought it thinking, okay, it's about to break, and then whoa, it flushes down, they stop out. Then a moment later, it comes right back up and breaks through it. Now, when it comes back up, the fact that it can recover like that does show strength. Yes, the drop is weakness, but the recovery is a sign of strength. And if it can break through that level, the breakout will usually be fierce because of the fact that everyone got knocked out of it. Not everyone, but a lot of people got knocked out. Those people are now going to come back in, and then you're going to have, as a result, more buy orders, more buying at the breakout of 6, and that's going to fuel that squeeze up to 650 and 620. It's also not impossible that it could go right back to 6, go to 605, and then do the same thing again. So you do have to be careful about not overstaying your welcome on some of these. All right, so with that, we'll go into Chapter 5, Pattern 3 on the moving average and volume weighted average price pullbacks. All right, everyone, so we're going to pick back up here with Chapter 5, Pattern 3, moving average and volume weighted average price VWAP pullbacks. All right, so a moving average VWAP pullback is definitely different than a bull flag or a flat top breakout. There are times where a bull flag will also kind of be a moving average pullback or a VWAP pullback where during the pullback candles, it actually pulls right back to one of those levels, and then we would say that was also a dip off volume weighted average price. But to sort of identify this as its own setup, the moving average pullback or the VWAP pullback typically happens when either it's sold off quite a bit more than what would be typical for a good bull flag and is now kind of resting on that moving average. So as you can see here from this sort of little chart, this was a bull flag right here and right off the 9 moving average. And then down here, again, this is kind of a, it's a bull flag, but it's a longer one. It's not quite as clean. It sort of is resting here on the 9 moving average. And because it's pulled back so much, probably people have lost interest in it a little bit. So the first candle to make a new high doesn't get the same level of follow through, then it drops back down. And then as it curls here, this is where it's kind of a curling off of that moving average or the volume weighted average price. So moving average pullback usually has the following characteristics: 3+ green candles moving up very quickly, followed by usually 2 or more red candles of consolidation above the 9 EMA. And it may start out as a bull flag or even start out as a flat top breakout, but that ends up either having a false break or just kind of pulling back a little bit more, consolidating for a longer period of time. And then at that point, it's a failed bull flag, or it's just not really as strong. And then that's where we start to just look at it as a moving average pullback. A perfect 5-minute pullback will pull back right to the 9 EMA on the 5-minute chart, as sometimes these will continue to fade all the way back to the VWAP. And that means the new entry is going to be around the support of the volume weighted average price. The only problem with this setup is that the entry point's not always very clear. And that's because the first candle to make a new high is no longer as significant because we're kind of experiencing just general consolidation. And so for that reason, sometimes we'll end up waiting to take our entry for the price to really kind of break back out to the upside over one of the more critical levels, perhaps a pivot, which is something we'll talk about in a moment. So in this case here, this is kind of a good example where this stock squeezed up at the open and then kind of pulled back sharply. Now it pulled all the way back down to the 9 moving average. The first 5-minute candle made a new high, but then came back down. So it sort of, started to break out and then failed. And that would have been right down in here. And then it kind of bases out and gives it another try. As it breaks over that level, the high of that red candle, there it starts to open up a little more. And then it pulls back, and now we're having a little bit more of a proper 1-minute pullback after it's a fresh breakout. It curls back up to the high, it pulls back again just for a moment, and then pops through, looks like about $3.10 or something like that. So right around here. Then it squeezes up to 340, 1-minute pullback, squeezes up to 360. Now we're getting a little bit of a 5-minute pullback. It kind of goes higher. And then in this area, we're back to a pullback on the 5-minute, kind of around the moving average. So this second one is a little bit more of a traditional bull flag, whereas the first one, because it's a failed bull flag, I start kind of looking at it a little bit more as a moving average pullback. Again, generally when we're talking about moving average pullbacks, we're talking about bull flags that are just kind of not clean. Here's another one in this area right here, where it had such an extended move from 2 all the way to 550 or so, that when it pulled back, it had a really sharp pullback. And that's not uncommon that you'll see a really big move and then a really sharp pullback. So now the first candle to make a new high, it was a high of over 5 and then it pulls back down to like 360 or whatever. So, it's a big pullback. It does bounce back up, but then kind of pulls back again. You can see on the 1-minute chart how it actually got below its 20 moving average. It reclaimed it, it broke back below it, and then as it surged up here, this is where things started to look a little bit stronger as we got that curl up to 450 and then to 5 and then, clean follow through. But initially it was a little choppy there because it had pulled back so much. Here's another one. This is a little bit of a different example where you did have kind of a premature bull flag right here up very high. And at that time, a couple of the reasons we would have been cautious about trading that bull flag was because it was extended off the 9 moving average. A perfect bull flag usually almost taps the 9 moving average before, going higher. So a little extended, it does surge up to 18. It then does a little bit of a false breakout here, and then it kind of sells off. So it's sort of a flat top there with 2 taps at 18. Then it kind of comes a little lower. And at this point, this is a very typical type of moving average pullback where you might think, should I be buying it here? That candle made a new high, but I don't know because this was a false breakout. And then do I buy it here? Well, this candle made a new high. I don't know. So where is the obvious place? In this situation, this particular chart, the obvious place is really over 18. But as it starts to show some real strength here with that volume coming in, we would have been able to visualize that volume as we read the tape. And as we saw it squeezing up, that would have been possibly an early indicator to jump in. This is, of course, a 5-minute chart. So we don't know whether or not there was a 1 minute micro pullback inside this 5-minute candle right here. And this is another sort of moving average, not a moving average pullback, but a moving average pop, where it curls up to the moving average here and then kind of fades off that level. So whether it's a moving average pop or a VWAP, the volume weighted average price we're going to talk about pretty extensively when we get into a couple of our classes specific to trading volume weighted average price VWAP breakouts and VWAP fades and dips off the VWAP. But it's a very similar chart pattern, with the exception that when a stock usually comes all the way down to VWAP, oftentimes that's a pretty big pullback if a stock has been quite strong. I'm not sure if I have a good example just off the top of my head. I'm opening my charts here, but just off the top of my head of a fade well, actually this is well, as it turns out, this one's not a terrible example here on Lizzie, which is the stock that we were watching yesterday. So Lizzie here, this actually ended up being a moving average bounce off VWAP right there. So see how this pulled back right here on this first pullback? This was pretty reasonably, bull flag and off of both the 9 and the VWAP. So that was a bull flag with moving average support right underneath it. This pullback here was to the 9. It did a false breakout and went higher. It came back down and bounced off the VWAP, and then from there at $8 has gone now up to 10 or just about. So that ends up being a little bit more of the volume weighted average price kind of curl. So again, we look at both the 9 EMA and then the VWAP as two potential places where we might find support if a stock starts to base out there. And in this case, you can see that break through 9 also could have been an okay place to take an entry. It surged up to 940 on the 5-minute chart, but you can see it hit actually 911, then it pulled back to 879, then it popped up to 940, and then dropped to 892 before popping up to 988. So this one actually is a little choppy on the 1-minute chart. It doesn't show really clean and clear entries, and even the 5-minute sort of reflects that in some of these green doji candles. So it's sometimes when, oh, sorry about that, my video's in the way. So it's sometimes when a stock is getting a bit more extended here, or just happens to be a little choppier, that we'll end up seeing these pullbacks down to the volume weighted average price or the moving average, because traders are just getting a little hesitant buying the first candles to make a new high because they kind of keep failing, and it's just sort of you start to sort of get some choppiness there. And again, to the short side, in the case of GME yesterday, I'm sure we could find some other examples of moving average pops where it was selling off, then kind of comes up to the moving average. It's not really a perfect bear flag. It's sort of back up to the moving average, then it flushes down. Sort of back up and then sort of flushes down. So it's a little bit more of a pattern that you'll notice kind of when you step back and, just kind of say, well, what is this stock doing? And it appears that it's holding this sort of moving average line, that it's generally trending up, but it pulls back a bit. It's not really clean to where it pulls back to, but then it does go ahead and break and move higher. Typically, the strongest stocks that I trade, we won't be doing a lot of moving average pullbacks on them because they really they're so strong that they have those brief bull flags and then rip higher, or brief micro pullbacks and then rip higher. A moving average pullback is definitely a little bit more of a sign that the stock is struggling a little bit. So again, though, this is just a brief example of this pattern, which you'll see more of as we continue on through the classes. So with that, we're going to go on to Chapter 5 and Pattern 4, which is the ABCD pattern, a pattern which sometimes does correspond as a moving average pullback or around the VWAP, but is kind of combining both a bull flag and a moving average pullback into what can be a super strong setup. All right, so we're going to continue on here with Chapter 5, Pattern 4, the ABCD pattern. This is a very powerful pattern. It's one that I really like. It consists typically of a bull flag that perhaps could have been a winning trade, but that didn't go all the way back to the highs, or at least didn't break through the high of day. So it's the pullback and the pop-up, which is from that point just right there, a traditional bull flag, but then it doesn't break the high and it comes back down. What's important as it comes back down is that 0.3 here, we don't like to see it break below the low of 0.1, because if it does, then the stock is just stair-stepping lower. You know, it comes down, it comes up a little bit, then it goes lower. So that's trending down. So what we want to see here instead is that it pulls back, it pops up, it doesn't break the high, but then it pulls back again, it doesn't break the low. So we're getting into this kind of wedge pattern here that is going to force an apex point. Now, number 4 here is when we break out, and the correct entry on this will vary depending on how aggressive you want to be. It could be as low as the first candle to make a new high here, which is sort of in the second bull flag, but of course it's not exactly a bull flag because this hasn't moved up enough to really be considered a bull flag, but it would be either down here or waiting for the confirmation, which would be a break over the high of this candle here and or the high of this candle here. So those are our possible entry points on it. So an ABCD pattern has the following characteristics. Usually 3 green candles in a row, sharp, very strong momentum, and then 2 or more candles of consolidation above the 9 EMA. Then a first 5-minute candle to make a new high that does not break the high of day. Then it pulls back again, but on that pullback, it doesn't go lower than the previous pullback. Maybe it double bottoms, but it doesn't go lower. And then as it curls back up for that second attempt, that's where we look for the resolution. Oftentimes, this pattern will exist directly kind of above the 9 EMA. Sometimes it occurs around the volume weighted average price if the stock is pulled back a little bit more. But this is one of my favorite patterns because it takes a while to form. It gives the opportunity for a lot of traders to see it. And so we have several, there's many examples actually when we get into this as a strategy, my strategy around trading it. Right now, again, recognizing the pattern, but this is one that you'll hear me talk about a lot. So the entry point is the break of number 2 there, point 2, and then for the leg up. A 1-minute ABCD pattern is typically a 5-minute bull flag. Now that might be kind of confusing at first, but think about a 5-minute bull flag. The stock has moved up and then is pulling back, but it usually doesn't go straight down. And so on the 1 minute, while that 5-minute is forming, sometimes the 1 minute has pulled back, popped up, pulled back, and is now getting ready to do a 1-minute ABCD pattern. So when you have a 1-minute ABCD pattern, and on the 5-minute you're forming a bull flag, then sometimes that gives us more confidence to take the 5-minute bull flag because the 1 minute is so strong, and then therefore we have multi-time frame alignment. It's not the same exact pattern occurring on both time frames. It's an ABCD pattern and then a 5-minute bull flag, but that's still a really good sign of strength. So here's an example of an ABCD pattern. This is actually a perfect example of multi-time frame alignment because the ABCD pattern is on the 1-minute chart, whereas the 5-minute is a bull flag. So on the 5-minute chart, we have that nice ramp up, pretty good volume, a little bit of a decline in volume as we got higher, which we don't usually like to see, but sometimes happens. High was about 560. It pulls back 1, 2, 3 candles. Then first candle to make a new high is over 545 right here. So the low is $5. The pop is 545. Comes back down and sort of double bottoms. As it comes back up here and breaks through that level, boom, that's the entry. Sometimes an ABCD pattern will also look a little bit like a W. Down, up, like that. But sometimes they're kind of skewed a little bit depending on how low the second leg came. So the W is for winner. So that's the perfect winning pattern right there. So the apex point here was 545, although we certainly could have just waited to get in at the high of day, but realistically 545 to anticipate the break through the $0.50 would have been a good entry. You could have gotten in down here as a double bottom, as it came down towards 5 and you knew that this was the previous low. That's a little aggressive. That's not a beginner strategy, but there are times where you might see me do something like that. And again, there's quite a bit of intuition that comes into taking a trade like that. VTAE, so on this one, we have another 1-minute setup here, 1-minute ABCD pattern, the pop up, the pullback, the pop up, the pullback, and then the squeeze higher. This one doesn't really take that perfect W formation, kind of has a funny drop right here, but you can see how the pattern is similar. It pulls back, it pops up, it pulls back, but doesn't break this low here. And then as it curls here through number 2 right there, the high, we get that squeeze through 13, 14, 15, or to 1450. And on the 5-minute, inside that was a pretty tight bull flag. Not a super perfect bull flag, but not bad. Yeah, and I see your comment there on the stock Lizzie right now. So Lizzie on the 1-minute right now, Yeah, I mean, yes, you're right that that is a very tight pullback, pop up there. Oops, wrong way. Pop up there, pull back, and then a break right here. You're right about that. And so, yes, that was 10.08. That high of this candle could have been an entry maybe at 10 for the break. The high was 10.35. It's a little tight, and the 5-minute chart is a little extended. So I don't know that that's one that I probably would have traded at that time. It's not really multi-time frame alignment. But yes, you're right that when you see something like this forming, to visualize that, okay, if it breaks through that level, that's bullish, is definitely correct. And if it breaks through the low here, that's bearish, right? So you're definitely starting to use these patterns to identify the highs and the lows, knowing above the highs is bullish and below the lows is bearish. And now here we have the problem, which is that this 5-minute candle, which has about 2.5 minutes left on it, is forming a topping tail and is red. So, this may not, this is a spot where if I was in it, I probably wouldn't want to be holding, because if this does end up being red with a topping tail, it could pull back, and it could pull back all the way down to the volume weighted average price and then still rally later in the day, but I don't want to hold it down over $1 a share. So here's another example. This is a stock that this pattern on the 5-minute was not occurring at high of day. Typically, I usually like to trade stocks that are at high of day. That's when they're sort of the most bullish and the most exciting. That wasn't the case with this particular pattern. As you can see, it sold off, it curled back up, but then dropped, popped up, pulled back, and it was starting to show those signs of an ABCD pattern. And it broke through that level there and then popped up. Then it did a little bull flag right here before ripping higher through the open. Again, it's not typical that you'll see me trade this. My scanners and the scanners that a lot of traders use are tuned to look for stocks hitting new highs, new high of day. And so if it's not hitting new high of day, it's not going to hit my scanners. So this wouldn't actually hit my scanner until it breaks over this level way up here. It's got to get over this level up here in order to be, giving us a shot at being on the scanner and therefore catching the attention of more traders. All these trading platforms that have scanners on them, top lists and things like that, it's not going to be on a top list scanner if it's not above the open price, most likely. I mean, unless it was a big gap. But anyway, so here's another one. Now, on this one, I didn't draw it out for you, but my guess is that you'll be able to visualize it. The stock squeezes up and we have a 5-minute bull flag. It squeezes up and then pulls back kind of sharply. It pops off the VWAP, so a little bit of a moving average VWAP pullback, back up to here. It pulls back, taps off the VWAP a second time there, and is now starting to curl with the correct entry, probably at about, that looks like 278, the high of this candle here. Target high of day. Then it squeezes up nicely, pulls back, first 1-minute candle to make a new high, or 5-minute, pops up. And this is not exactly an ABCD pattern right here, because it didn't really pull back much, but clearly if it broke over that level there, that was where it starts to look pretty bullish again. So we can understand that pattern as well. And here's another one. Again, they're not always, the W on this is sort of very inverted because it didn't really pull back that much. Sometimes it drops, pops up, and just pulls back just for a moment, right underneath the highs. And when that's the case, we would also sometimes call that a cup and handle formation. So just to draw that out for you here, so the cup and handle is, it's essentially like a bull flag. So what we have is this pattern right here. Oops. So we have this pattern right here where we have the bull flag. It pulls back, it resolves back up, but then is a double top. So when we get that double top, right there at the top, right there at the top, when we have that double top, what we sometimes say is, okay, that is a cup, and what we want is the little formation of a handle. And so the handle is that little teeny pullback right underneath the highs for then that break higher. Now, I actually drew almost the same exact pattern yesterday. I'm trying to remember what that was about yesterday. I don't remember if I was just drawing the bull flag or the flat top breakout, perhaps. I think I was drawing the flat top breakout because this, at this point, does start to become a flat top breakout. But if you ever hear someone say that that's a cup, That's also correct. So that double top right there, right here, kind of forms the cup with the negative space being in the middle. And then the little handle helps provide us with a little bit of lower risk if we're thinking about taking the trade. And so this, it's not perfect, but that's kind of that cup and little handle before the next leg up. We'll see it both on the 1 minute and the 5 minute. Here's another one that's a little bit more of that W because the low here did pull back, and in this case, it pulled right back down to the volume weighted average price. So we have that squeeze from 540 up to 7, pulls back sharply, pops back up, pulls back, first candle to make a new high, rips back up here to 720. So that was the apex right there. That was the spot. All right, so again, we're going to see lots of examples of that when we get into strategy development, but now you know the pattern. So let's continue on to Chapter 5, Pattern 5.